So the way I came up with that is I thought, okay, well, let's create a stable core, if you like. So the core should be the majority of the fund. So that's 60 to 80% of the fund is invested in what we call core businesses. These businesses have proven themselves over the many years to show consistent growth. So these are companies that are essentially winners in what they do. So they've got dominant market share, their management team's proven to be very competent, they've got great product, service, or whatever it is they do, and they've got a great tailwind that'll help them along. So if we have, the theory goes that if you have enough of these companies that are that are uncorrelated, if you like, and benefit from many different and kind of drivers, you have this this consistent kind of growth, and that's the idea. So this is like the super tanker, if you like, of the fund. So whenever sees a rough or flat, this massive super tanker will keep steaming along. Now, then we accept that during this experience over time, you have many cycles. So you want to capture those cycles, you don't want to ignore the cycles. So at times you'll be presented with great opportunities to buy excellent businesses, similar to the ones we just outlined, but with maybe a higher kind of cyclicality in their business. And these could be anything from industrial businesses to mining companies to, say, even banks we include in this bucket. So there we do a lot of work on the actual cycle. And the final bucket we have is what we call opportunistic. And these are the kind of companies that maybe carry a bit more risk. Whether it be a tech company that's growing very rapidly and we want to temper our investment in that because we know that things can change over time, but it's a great opportunity, so we still don't want to miss out on that. Or it could be let's say something like a great company that's undergoing a temporary blip in their evolution. So these three buckets, one provides stability, the other one's and consistent returns over time. The other two provide opportunistic kind of investments that give us that extra boost in performance when the opportunity kind of permits. The holding period for each of the buckets is expected to be different. It can vary, but on average, the core should be between 3 and 7 years on average, sometimes longer. So if you're truly buying a company that benefits over the long term from long-term thematics, you should be able to benefit from that over a very long period. Cyclical and opportunistic, typically you would expect 1 to 3 years for a cycle to play out or your thesis to play out and for you to either make your money and get out or get it wrong and get out. Because in the way we lower the risk further for these riskier buckets of cyclical and opportunistic is we run stop losses. So even if we get it wrong, there's a maximum amount that we can get it wrong. So 1 to 3 years for cyclical opportunistic, anywhere beyond 5 years for core.